Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Free cash flow yield is the surplus cash after expenses and investments divided by the price of the security. Free cash flow yield has been used for a long time by active hedge funds, and now it has become part of the indexing landscape, competing for assets with other quantitative approaches. It has historically outperformed in markets that favored value stocks and shown resilience in growth markets. My guest today will explain why, in today's intangible, asset driven economy, traditional metrics like price to earnings and price to book face challenges, making free cash flow a more relevant valuation metric. We will discuss how advisors should think about free cash flow and the steps VictoryShares and Solutions has taken to enhance traditional approaches. Michael Mack is an associate portfolio manager with VictoryShares, and in that role, he leverages his experience in portfolio management and product development to support and grow the firm's rules based and custom investment solutions. So, Michael, welcome. Tell me about your career path and what led you to VictoryShares.
Yeah, thanks for having me today, Bob. It started when I was in graduate school. I got a chance to attend value investing seminars, which were hosted by a group of value investors who had the opportunity to train and learn under Warren Buffett. So it was a fantastic experience for me to get to learn firsthand what in value investing was. I actually got to meet him once, and it was pretty cool. I think I still even have it as my Facebook photo.
But the main thing I took away from it is the importance of trying to identify quality businesses at attractive prices. And the next step in my career was I ended up at a long, short quantitative hedge fund, kind of the opposite of what you'd think of when you're talking about Warren Buffett. But it was there that I got exposed to the concept of free cash flow yield and the benefits of implementing it through a systematic approach, which I was then able to take to my next role at an ETF issuer, where I was able to help them build out their ETF platform. But also, more specifically, I was able to help lead the design of a series of free cash flow focused ETFs, which in that process, I got to talk to a lot of financial advisors about ways to implement free cash flow in their portfolios. And it was during this process that I got to witness the huge demand from advisors for high free cash flow strategies, which leads me to where I am today, Victory Capital, a place I knew where I wanted to be for a while. In joining the team, I was able to learn some of the ideas they had in how to best implement free cash flow. And in particular, two ideas that they came up with that I thought were interesting of if you take free cash flow, you need to apply it using a forward-looking approach. And in addition to that forward-looking approach, you need to apply a growth filter. And so when you think about that you have the idea of identifying attractively valued companies with relatively favorable growth prospects. And in my opinion, that represents the latest evolution in the concept of free cash flow yield as an investment factor.
Tell me about Victory Capital and the team that you work on.
Yeah, so Victory Capital is a diversified global asset management firm. We employ a next generation business strategy that combines boutique investment qualities with the benefits of a fully integrated, centralized operating and distribution platform. But what that means is if you're an investment franchise at Victory Capital, you get to spend all of your focus on managing investment portfolios for clients, which we believe will ultimately result in the best outcome for those clients. And one of the things working here I've gotten to really come to appreciate about this model is, hearing our CEO talk about the importance of investment autonomy, but also how this model really lends itself to the diversity of thought. So if you think about the team I'm on, Victory Capital Solutions, we have the unique opportunity to interface with all the different investment franchises. And so part of our day is helping manage the active and passive quantitative investment strategies. But another part of our role is working on the multi-manager side of the business, where we get to kind of sit in the financial advisor's shoes and evaluate different investment managers. And the two benefits of that is, one, we get exposed to the best ideas from different managers. You're also getting different perspectives in terms of how the investing world works. And so one day we could be talking to a value manager, the next day we could be talking to a growth manager. And the way this kind of helped, it's turned into a new idea for clients is we recently launched an ETF this summer called the VictoryShares Free-cashflow ETF, which seeks to track an index of high free cash flow yield companies with relatively favorable growth prospects. What we think is unique about that approach is that it combines both value and growth elements. So if you take Warren Buffett, we talked about Warren Buffett earlier. He has a great quote talking about value and growth, where traditionally a lot of people have viewed value and growth as in opposition to one another. But in his mind, growth is always a factor in the determination of value. So when you think about it, if you have two companies trading at the same valuation ratio, it's the faster growing company that represents the more attractively valued opportunity. And so, all else equal, a faster growing company should trade at a higher multiple. And if you're able to buy that higher growth company at the same valuation, that's something you want to take advantage of. So if you think about the idea of taking a value and growth approach together, we think it's one example of how our business model allows us to come up with innovative new solutions for our clients.
So you mentioned your ETF, the symbol for it is VFlow. As I mentioned in my introduction, the concept of free cash flow has been used for a long time in the active space. Tell me about how you applied it to creating VFlow and using it on the index side.
And so if you look at the academic research and where most of the data is available, it's on factors like price to book, which we know from an active manager perspective, it's ultimately free cash flow that matters. Yet most traditional value benchmark indexes are heavily reliant only on price to book. And so we think this creates an opportunity to create an index that focuses on free cash flow.
So it's a less followed metric, giving you more opportunity to capture a market inefficiency. I mentioned in my introduction the definition of free cash flow, but why don't you expand on that and revisit some of the basics? What exactly is free cash flow and why is it essential to the health of a company?
Yeah, free cash flow, it represents the cash that's left over after the company has reinvested in the business, which means it's available to do things like buy back stock, pay and grow a dividend, participate in M&A. And if you think about all of these potentially shareholder friendly actions you can take, they're all made possible by having free cash flow. In order to generate a lot of free cash flow, what you typically see is a company, the amount of cash that's coming into the business is growing faster than the amount of cash they spend, which is a sign of a healthy company. Now, in terms of performance, we did a study recently on the S&P 500, which it's available on our website if you go to VictoryShares.com for additional information, as well as a link to the prospectus. What you'll see on the website is there's a piece where we looked at the historical performance over the past 30 years using the S&P 500. And what we did is we broke the S&P 500 into different buckets based on each valuation factor. And what came out of that is we discovered that free cash flow had been the best performing factor over the past 30 years. So if you think about why that may be potentially the case, you go back to what we talked about earlier, and that the definition of how a company is valued and how that value is determined is really a function of free cash flow.
So you mentioned that study that looked at the performance of different metrics for the S&P, putting those metrics into different buckets. Why is it that free cash flow is better than price to earnings or price to book?
Yeah, so if you think about historically, if you just take like a manufacturing company, how you would value that business. If you use an example like price to book. Price to book is attempting to value a company based on their book value, which at the end of the day is their assets minus their liabilities. And so in order to understand their book value, you need to be able to understand their assets. And if you think of a traditional manufacturing company, the assets they used tended to be based on physical, tangible assets. So things you can touch and feel. Like if you think of the land that you would need to build a plant on, the building structure itself, the equipment, everything that goes into producing whatever product you're producing, it's all physical, tangible assets that most importantly, they're easy to quantify. And so we can measure them and determine a company's assets and therefore their book value. If you look at the market today, most of the value in the stock market is coming from companies that use a lot of intangible assets. And so if you think about it, it's really intellectual property. It's things that are harder to quantify. So if you think about patents, brands, um, those are all things that it's not easy to place a number on, but they're very important in the modern economy. And so instead of worrying about how to value a company based on their assets, what we think is you want to look at a company's cash flow, where regardless of how they generate their cash flows, whether it's intangible or tangible assets, you can just follow the cash flow to get a signal for how well the company is doing. And so it's one of the ways we think free cash flow is positioned to benefit as the economy continues to evolve over time.
Can you give me an example of maybe a company that you've been able to analyze through the lens of free cash flow that gave you more insight than either of those traditional metrics that you've mentioned?
Yeah, I think one examples is like if you think about like using forward free cash flow versus historical. So one of the things that's unique about our approach is we take a forward-looking approach in how we view it. So we look at not just the company's historical 12-month free cash flow, but we also look at their next 12-month free cash flow based on analyst estimates and take that average as our baseline of a company's free cash flow. And what that does, if you take, for instance, like an oil company, there have been times in the past where oil prices were high, and then suddenly we experienced a steep decline in the price of oil. In those cases, if you were to look at a company and value them based on their historical free cash flow, you would run the risk of buying a company at a cyclical peak when we know based on the current oil price at that time, right, the company was likely to see their free cash flow go down in the future because oil prices had recently experienced a decline. And so by taking a forward-looking approach, you're able to potentially avoid some of those value traps that come where the free cash flow is expected to decline in the future based on what we know today.
What about using enterprise value in the calculation rather than market cap? Which is better?
Yeah, traditionally a lot of value strategies have tended to value a company based on their market cap. Now, if you think about what we're trying to do with free cash flow yield, so we talked earlier about free cash flow and taking the average to get a forward-looking view of it, but free cash flow yield, what it's trying to answer is how much cash flow am I getting in this business relative to the cost of acquiring that business. And so, if you wanted to know how much it would take to acquire a business, you need to think not just about the price of their stock, but also what's on their balance sheet. In particular, how much cash they have and how much debt they have. And so that's what we're solving. The way we define free cash flow is free cash flow over enterprise value. And an example of where that can help you is if, like take an airline, for instance, it's a very capital intensive business. And so they oftentimes have a lot of debt. And so if you were to value an airline based on just the price of their stock without accounting for that debt, you could think that airlines are always cheap. When in reality, a lot of the time, after you adjust for that higher debt level, the companies are a lot less attractively valued. And so in that case, using enterprise value gives you a more comprehensive assessment of how much the company or how attractive the company's valuation is. And then if you think about too, right, the fact that you're focusing on a company's balance sheet over time, we think that process allows you to tilt towards companies with stronger balance sheets, which adds a quality element in addition to value.
So, stepping back here, you mentioned that over the course of your career, you've spoken with a lot of financial advisors. I'm sure you're having many of those conversations now. What are you hearing?
Yeah, and talking with financial advisors, especially in the last 3 years, they'll all tell you that one of the things they're struggling with is they know that every time you get these narrow concentrated growth markets where a handful of names are driving the returns, they know historically chasing that momentum hasn't ended up well for their clients. And yet, when you talk to them, they're struggling every day in their conversations with clients because if they still own value, oftentimes their portfolios are going to be positioned towards companies like utilities, real estate, and financials. And they're getting questions for their clients like, given how the economy is changing and evolving, and how if I'm a client every day in my life, I'm seeing the impact technology is having, I'm starting to wonder why so much of my portfolio is represented in these areas of the economy that really were more relevant 50 years ago. And so that's where free cash flow yield comes into play. What's interesting about free cash flow is if you look at where free cash flow has historically found value over time, it's been in sectors like technology, consumer, healthcare. These are all sectors that have traditionally been considered more growth oriented sectors. And so for clients, it allows them an opportunity to invest in attractively valued businesses, but also keep their portfolio positioned to the areas of the economy that are expected to grow in the future. You know, we were talking earlier about the demand from advisors for these strategies. This free cash flow, talking about introducing that concept to your client, has been very helpful for financial advisors in two ways. One, it helps keep their clients more satisfied with their current offerings. But number two, when you speak to advisors every day, one of the things they'll always tell you is they know even their existing clients, a lot of them have more assets that they could be investing with the advisor. And so if you're able to engage them more and get them excited about investing, they're seeing they're able to get more money from their clients. And so, again, and you think about from the client's perspective, what's so attractive about free cash flow yield is it's very intuitive. In everyone's everyday life, everyone knows someone who's house rich, cash poor, or the neighbor across the street who's trying to keep up with the Joneses. And so the idea of the importance of having a strong balance sheet or healthy cash flows, that resonates with clients, which makes financial advisors' job a lot easier.
So it sounds like there's a diversification benefit to free cash flow, giving you exposure to sectors like healthcare and technology that you mentioned. How do advisors view that? How do they use cash flow yield to identify or talk about opportunities across industries and investment styles while still maintaining a balanced portfolio for their clients?
Yeah, the way we're seeing advisors implement this is there's a couple ways. One, if you think about it, we talked earlier about how it's been very effective at identifying value versus traditional value factors. So for advisors who are bullish on value versus growth, they're using this as a way to increase the value exposure in their portfolio. Now, the next example is a little bit more counterintuitive from what you would think, but for advisors who are bullish on growth, they're still using a value strategy like this as an opportunity to improve their portfolios. And the reason is, if you think about, as we talked about earlier, where free cash flow yield has found value, places like technology, healthcare, and consumer, those are places that have tended to hold up better in a growth market. And so when you think about implementing free cash flow yield, it has the great feature of being a lot more resilient in a growth market versus other value factors. And so for people who are bullish on growth, they're using this as a way to replace their existing value strategies and hopefully build some resiliency on that side of the portfolio. And then the last part is we've kind of talked about quality, value, and growth characteristics throughout this uh, podcast. And so if you think about that, in this case, some people are viewing this as a core position as well. Now, we always, to level set expectations here, we always want to explain to clients that the way we think about growth markets is there's really two types. There's moderately growth markets, let's say a 2021 type market, where free cash flow has tended to do well. But then we also do get these markets like you saw in the late 90s, 2020 or 2023, where you get these narrow concentrated growth markets. And so we always recommend clients own this in conjunction with other growth strategies where when you get these narrow markets, you have some mega cap growth exposure to complement a strategy like this.
So tell me about VFlow, about the index that it tracks, and the history behind it.
A lot of advisors came to us saying that they really wanted us to focus on the large cap value side of the equation. So number one, if you think about sectors, we exclude financials and real estate just because as a function of the business, right? You can't really assess those companies using free cash flow. So from there, after excluding those sectors, we then look at the VettaFi US universe and we select the 400 largest profitable companies. And so from that universe of profitable companies, we then select the 75 highest companies based on their expected free cash flow yield. And so from that 75 name universe, we then apply a growth filter, selecting the 50 companies with the highest growth rates. And then the last step in that process is we weight that by the company's free cash flow. By employing this process, you're able to go from a universe with a free cash flow yield of 4%, increase that up to 10%, without sacrificing too much on the growth side. And so the companies that you own then, right, have a growth rate of 10 and a half versus 12. And so you're able to get substantial pickup in free cash flow yield without sacrificing that much on the growth side of the equation.
The expense ratio is, I believe, 39 basis points. Tell me about the risk management discipline. How do you diversify across sectors or industries?
Yeah, so we have a sector cap, an absolute sector cap. So no sector may exceed 45% of the index at the time of rebalance. And then we also have another guardrail regarding how overweight we can be in any sector. So no sector can represent more than a 20% overweight versus the parent index. So an example today would be energy, where you have, energy represents 5 to 6% of the parent index, the VettaFi 1000 in this case. But if you look at where we are, right, we are currently 26% in the index, and so that's because that's being capped to be no more than 20% over the index.
If there's one key takeaway that you'd like to leave with our audience of financial advisors about the diligence that they should perform to determine which metric, free cash flow, price to earnings, price to book, or something else, is likely to perform the best, what would that be?
Yeah, I love this question. I would say if you're thinking about different metrics, right? How much do they? How important are they in determining how much a business is worth? That's the first thing I would say. The other thing to think about is how relevant is that metric in today's economy? And then to the second point, it's interesting when you look at a lot of value indexes out there, we think it's important to look at the valuation that index has. So whether you're looking at the index PE or the free cash flow yield, are they offering significant discounts or are they just tilting you towards that factor? And so one of the ways we like to think about this is if you were to add a strategy in your portfolio, take a look at what it would do to the valuation of your overall portfolio. And so one of the things we like about free cash flow yield is we think it can help you move the needle in terms of lowering the valuation in your portfolio. And if you think about like the why now today, historically high free cash flow yield companies have traded at a 20 to 30% discount based on price to earnings ratio. Today, they're trading at closer to 40 or 50%. So you're almost getting twice the discount that you've normally seen. And so we get questions from advisors like, have I missed the run in free cash flow yield? And to us, we think there's still legs to this. In fact, if you look at the valuations, we think it's free cash flow yield as an investment factor is the most attractive it's been in a long time.
Well, we will include links to some resources in the notes that accompany this podcast. There will be links to the VictoryShares free cash flow product page, a brochure about VFlow, a fact sheet about VFlow, and a link to the VettaFi free cash flow channel. Michael, is there anything else you'd like to add?
Yeah, I'd just like to say that, if anyone's looking for any additional information, please go to VictoryShares.com and also where you can get a link to the prospectus. And then for the advisors out there, if you require any additional information, please feel free to contact your respective Victory Capital sales director, or you may contact the Victory Capital internal sales desk at 1-800-991-8191. Thanks for having me on today, Bob.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Michael Mack of VictoryShares. To support our podcast, please Share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service. Carefully consider the fund's investment objectives, risks, charges, and expenses before investing. To obtain a prospectus or summary prospectus containing this and other important information, visit vcm.com/prospectus. Read it carefully before investing. All investing involves risk, including the potential loss of principal.